welcome to TradeHappy. Welcome back to another Traders Podcast episode. Sit back and grab a notepad and pen. This one is a really good episode with a commodities trader who spoke about making over £900,000 in a single day. If you're looking to be a big trader and grow other sources of income outside of trading, this is going to be a really good episode for you. If you have any questions, just drop them in the comments below. I'm sure he'll be happy to answer those for you. But yeah, hopefully you enjoy it. Sit back, relax, take some notes. Please welcome Neil. So for anyone that doesn't know who you are, can you just tell us a bit about yourself?
So yeah, my name's Neil Doig. I am the author of Millennial Money Mindset. If you want the fruits, you need the roots. The creator of a card game called Football Formation Asset Allocation. And my company, I'm the founder of Money Tips, which stands for Tax, Investment, Property, Pension, Savings. So we're different. We offer educate, inspire, and give money coaching to help people make better decisions with their money.
Amazing. So how did you actually get into the finance world?
So I started off in the shipping industry, and so moving tankers around the world, so kind of giant oil tankers
Okay.
back in the day. This is back in during the kind of the boom times around when China was just opening up in the kind of 2000s. So I started off in the kind of contract side of things. I went to night school and got my chartered shipbroking qualification. I then moved to gas trading, which is probably going to be interesting for the listeners, and buying and selling kind of commodities. So you think of when you turn the heating on at home, that's gas, that commodity is gas. So buying and selling millions of pounds worth of that each day. And my biggest daily gain was £940,000 in a day. And I'm happy to talk about that later in the podcast.
Yeah.
But then got made redundant from that role and kind of gave me an opportunity to say, actually, what do I want to do with myself? So looked at my strengths, looked at where there's a demand and what I enjoy talking about on podcasts like this one, and decided to become a financial advisor, kind of helping high net worth individuals kind of how to manage their money. So I did all my qualifications, did kind of a number of different written qualifications, practical qualifications, had my own portfolio of clients where, so one of my clients had £15 million worth of Bitcoin winnings. He'd made fortune from Bitcoin and other kind of high net worth individuals. And then I kind of had a number of clients that I'd had kind of booked up, but then I kind of felt like, actually, do I really want to be helping kind of rich people save more tax? And I kind of had a conscience moment with that. So decided to I created my own company called Money Tips, which essentially we're different. So we don't offer financial advice, which is kind of specific advice. We offer financial guidance. So essentially we train, teach, and educate people how to make their own decisions around money.
Cool. So in terms of the trading, because that's obviously what we'll be talking about mostly during this podcast, what would you say were some of those lessons when you were commodity trading that you learned over the years?
So the big lesson is that it's actually really boring. Like kind of Hollywood image of this kind of trader, you see I had kind of 8 screens around me, kind of working 12-hour days. People think it's quite glamorous when I say I was a commodity trader, and maybe I kind of played to that on, like on the way home, like thinking I was kind of with saying how much I bought and sold that day, and kind of thinking that I was kind of really, clever. It's actually not like that at all. It's actually really boring. We had a checklist that we had to do each day, and it's actually the trading floor. Like good world-class traders are actually very disciplined, and it's more like a job than going to a job 9 to 5 than the actual Hollywood image of people on a phone buy now, sell now. It's not actually like that.
So obviously I don't know whether you'll be able to talk about this too much, but what would you say your average day was as a commodity trader then?
So it's all about essentially it's all about balancing. So think of it like each country has its own supply and demand of energy. So UK is a lot to do with gas. So you would have North Sea's got lots of gas and oil. So that would be a supply. So you would have X amount of gas coming into the country. And then when people turn on their heating at home, that's the demand. So the kind of the when it's really cold, so for instance, a February morning would be a massive high demand of gas. So you have to kind of plan your day around, basically you want to balance your supply and demand. And the number one thing you're looking for is what they call arbitrage. So arbitrage is essentially difference in pricing. So the way we made money was essentially, if it was really cold, looking at the way we made money mostly was during looking at weather patterns. So we had like a weather forecaster every day who would give us their kind of forecast over the next few days, next week. And if it's, say, for instance, really cold in the UK, the demand would go high. And if it was, say, warm in Germany, for instance, the demand would be lower. So the price would be lower. So you could buy gas in Germany and then pipe that over to the UK and then sell it at a higher price, taking into account the cost of pipelines, etc., and any risk. So essentially, that's as a trader, as a commodity trader, that's essentially what you were doing each day. You were looking for difference in pricing and how to manage that. And there was certain things happen during the day. So that all sounds quite simple and easy, but there was things like the supply would, all of a sudden there would be, there would be the gas would, there would be an explosion in the North Sea or something would happen. There was a pipeline would froze over, for instance, and that supply would get cut off. So there was a pipeline in Italy and there was a landslide, and basically there was a boulder that basically knocked out this gas pipeline. So we were expecting to get that gas that day. But then we looked at our screens like, what's going on? There's none of this gas coming through. So you're like, you have to basically source gas from somewhere else. So that day we went to France and we managed to buy gas. Basically, it's like a race, but before anyone else does. So obviously people know about that pipeline, then people are all going to start buying at different elsewhere, and then people, you're trying to beat everyone else. And there's, just to clarify, there's a difference between insider trading, which is illegal when it's not inside trading. There's information that gets put out to the market, and you're essentially trying to analyze this market, and you're going to make a call on if you're going to make money or not. So sometimes you make money, sometimes you don't, but it's all about managing your risk and understanding that.
And obviously,
that makes sense. Does that make sense?
Yeah.
I'm trying to work out like gauge the audience as well. So, but yeah, does that make sense? Essentially, it's all down to supply and demand. So coming back to Adam Smith and The Wealth of Nations, he was a guy that kind of wrote about capitalism in the 1750s. So if you ever study economics, if you go to university or whatever, so the first lesson you ever have on economics is demand versus supply. And it sounds really basic and it's really obvious, but every day you have to look at what's the demand for this product. It doesn't, we traded gas. It doesn't matter. It could be any product, anything. It could be, you could go to a market stall on a Sunday and, selling apples, and there's a demand supply of apples. If there's only one apple left and there's, 50 people wanting that apple desperately, then that shop can put the price of that apple up, if that makes sense. So fundamentally, it's all down to demand and supply. Like if you think of any market, it doesn't matter if it's the stock market, it doesn't matter if it's Forex, it doesn't matter if it's commodities. Fundamentally, it's all down to supply and demand. And we can talk about technicals and get more behavioral economics, behavioral trading, etc. But down, and it's all down to supply and demand.
Right. So let's say there's a trader right now. Obviously, it's a Saturday, so probably not going to be looking at the charts. But let's say there's a trader looking at their charts right now. How would they be able to apply this to their charts or their trading?
So it totally depends. So coming back to, there's a day where I made £940,000 in a day, which sounds insane. And that's not for me personally, that's for my company. And it was a huge FTSE 100 company. So when I say this number, actually it sounds more impressive than it actually was. I was in on Saturday morning, funny enough. So I was like sad enough to be like, actually, I want to get a bigger bonus. So I'm going to go on a Saturday because there was a potential for it. we looked at the weather, and it was a really, really cold February morning, and there was a big chance that there's going to be a massive spike of demand when people turn their heating up when they wake up that morning. So there was a pipeline that froze over in Norway, so that supply got cut, and people were waking up in the morning, turning on that gas, and essentially you're looking for that supply and demand imbalance, essentially. So we had clever, sophisticated systems that essentially they basically strip from computer screens, and they give us a real are we imbalanced? What's the balance? Kind of, are we long or are we short? But essentially, that's what we get. And that day we were like something crazy short by 30 meters, which is in gas speak. That's what they talk. But essentially, there was less gas than the demand. So there's going to be a massive spike of price. So if you can get in there and apply that, then that's where you're going to make money. But coming back to what lessons to learn from the people at home, like there's a massive difference between people who are trading for a job. So this was a job. This is not me on a morning trading for me personally. There's a massive difference between people understanding you're doing this for a job for a FTSE 100 company, which have the system, they have the training, they have people, the processes in place and the regulations, plus the capital, the money to do this, rather than me at home doing that today. Like I wouldn't have access to that information because you have to pay for a subscription model to know. I wouldn't know what's going on in Norway if a pipeline's frozen over today. Like I don't have access to that information. So I guess it's quite, what I'm talking about here is a job that I was a trader for a job, and you say the person at home who I suspect you want to make some money from your own personal account. There's a big difference between doing it for a job and doing it personally. Does that make sense?
Yeah. So do you think that a trader at home, whether they're trading for a prop firm or themselves, can still win in terms of overall, even though they don't have that access to the feed or news or whatever?
Yeah, so I'd always say look at the evidence. So I'm a big believer in evidence-based research. So you look at what is working, what's not working, and statistically, a trader at home you're massively not likely to, if you're trading every day. There was a study done in Brazil actually, and it showed if you're trading every day, it's like 70% of the day traders lose money. Like so, I'm saying it's impossible. I'm just saying statistically you're going to lose if you're just trading at home, buying and selling. There's a number of reasons for that, because if you're trading every day, you're day trading every day, you're paying for broker fees for once. So whatever platform you're using, that platform they're in business, they're making money somehow, either if that's a fee or if it's a difference between what they call the bid offer spread, so the difference between the buy and the sell price. You're going to be paying taxes. So I mean, there's a number of ways that you could put into an ISA, etc. Or there's a number of ways you don't need to pay, but essentially you're going to be paying taxes a lot of the time, and you're going to be paying. You're going to get it wrong a number of times as well. So, I mean, I'm a big believer I do trade myself. I'm not saying that it's wrong. It's just a different strategy. I'm much more, if you look at the evidence, investing for the long term is much more likely to say about winning. How are you going to win? Yeah. So if you're investing for the long term, you're much more likely to win. But then if you come on a podcast and say you're actually just going to invest, that's a bit boring. Like people love, there's an emotional part of us that we love to think that we're beating the system, or that we're winning, that we're cleverer than everyone else, and we can outsmart the market, which I'm not saying it's right or wrong. I mean, I love doing it myself. I've been doing it for 20 years, so there are ways to do it. It's just, I guess, how do you win? It's having an edge over the market.
Yeah.
Or actually, first of all, it's actually understanding. You say, can you win? It's understanding, what does a win mean to you? So some people think it's, you get a percentage more than the market. That's fine. That's one person thinking they're going to win. But actually, your podcast is called TradeHappy, and I think that's quite interesting because it's actually are you going to live a happier life? Like, not to be kind of too deep and meaningful, but like, yeah, it's actually what do you want out of life? That's understanding that is more important than, what stock to buy, or what should you be buying, $1 or should you be buying the yen, or it's actually what do you want out of life? It's more important question to answer
Yeah.
than what should you be buying. Does that make sense?
Yeah, I totally agree. I totally agree. I'm kind of glad that you've gone down that route. What would you say is one way that people can trade happier? Obviously, trading can be very,
Before
very
we answer that question,
stressful.
I guess I should clarify what difference between trading and investing. So there's a big difference as well. So
Yes.
the first difference we talked about was trading for a corporation. So I work for a FTSE 100 company, and trading for an individual. So there's different strategies there, and I'm happy to talk about those as well. And then you talked about difference between trading happy. So there's a difference between trading and investing. So where I think trading is buying and selling on the hope that someone else will pay more for that line on a screen. It's not right or wrong. I'm not saying it's necessarily wrong. I'm just saying you're trying to buy or sell something on the hope that someone on the other side will pay more for that. You're going to make money for that. Whereas investing, which I teach more about investing than trading, is buying actual living, breathing companies or living, breathing assets that you're gonna get that money put in plus a little bit more. So you might be buying property where you're getting a rent from your tenants. You might be buying businesses, which is walk down a high street, like you go into a shop and you buy a loaf of bread. Part of those profits are going to be paid back to the shareholder as a dividend. So as part of those profits, you're going to get so you can hold that for the long term, and every year you're going to get profits back for just by being an owner of that business or lending money to governments or corporations. By lending money, you can get paid what they call a coupon. For if you buy a bond, for instance, you buy a coupon, or think of it putting money into a bank. In the old days, you used to get interest rates on that. You used to get 5%. If you put £100 into a bank, you get £5 back every year. So coming back to answer your question, so there's a difference between trading and investing. So let's split those up. And you asked how to trade happy. It's down to the individual. What do you want out of life? What's your purpose, and what are you actually looking to achieve? I think is a more important question. I think the way I work with people, I have a life plan, actually what their aims, what objectives are, before you even come down to trading. Does that make sense?
Yep. Yeah.
Sorry, I've gone on off a tangent, but yeah.
No, it's all good. Yeah, I mean, I completely agree. That's something that we do as well. We help people with goals outside of trading as well, because we feel that it's just as important, if not more. So what's something traders can do to reduce stress of trading? Because obviously I'm sure you've dealt with very, very high stress situations. What's some advice that you would give to some traders to deal with stress?
Yes, a good question. So, I mean, I'm a big fan of automation. For me as an investor, I don't necessarily stress about my money anymore. So I talk about, what I call it is like money mindset, the way you think and feel about money, how you relate to money. And there's a lot of ways to do that. So I talk about having an emergency fund. So having a cash buffer before you even start trading. If you're trading and you're trying to make money to pay for your family's food at the end of the month, then that's going to be super stressful. Like if you're a trader, like a 9 to 5, that's your sole income, then that's super stressful. If you're like, right, I've got to make money from the market to pay for my groceries, like that's going to be super stressful, right? So I would always start off as a side hustle. Don't start don't trade thinking you're going to be Hollywood Image and buying and selling and you've got to pay for your rent or you've got to pay for your bills just from your trading income, that's crazy risk that you're taking there. So yeah,
Yeah.
start up a side hustle, start understanding how to invest, start understanding how the markets work, and yeah, don't try and take from the market. I think this is my kind of big takeaway. Like, don't take from the market. You're giving to the market. You're using your capital. You're putting money into the market to give. Right. So this is really, I've become a bit like not even woo woo in my old. I've been trading for like 20 years, and it's about, you've got money and you're investing it. How do you make that money work the best way possible, rather
Yeah.
than trying to take from the market? I see so many traders or actually thinking they're trying to scalp and trying to take from the market, rather than actually thinking, where can my money be? Where can this money make the greatest contribution? And this is more down to the investment route. So I'm much more, although I traded, I see myself as an investor. I don't see myself as a trader anymore. I see myself, I've hung up my boots of trading, because I think that I look at my strengths and where I personally can have an edge over the market. And I don't think that's with trading anymore. I'm with me personally, I'm quite a slow thinker. I like to ponder and I like to think about things. And if I'm trading, I get annihilated in trading. I try and think through things too much, even anything, like any decision I make. So when I was trading on the when I was trading gas, I'd be a very slow thinker. I'd be trying to analyze too much. So I'm much more suited to investing long term. So look at where were you good at school? Like, it sounds really silly, but like, what subjects were you good at school? So for me, I was good at geography. So I was like a geography nerd. Like, I love thinking about, you know, different countries around the world. What were they doing? What was the infrastructure on those companies? So the way I think about things, I'm much better at that. So if I was a trader now, I'd be actually thinking, like, where would be the arbitrage? Where's the biggest upsell? So I would see that I'd be looking at the African nations have huge upside. Like,
Yeah.
things like Vietnam would be got massive upside. I think things like South Korea. So if you look at, has been historically underpriced because of its relationship to North Korea. So there's a kind of a big kind of political risk there, which said in the market that's been underpriced. So I'd be saying, actually, where's there an arbitrage? Where's there a difference in price? And those three markets, I would be, as a geographer, I'd be like thinking, actually, those three markets today, if you look at that in 20 years time, there's going to be massive growth in the African nations. I mean, they've been held back for so long because of in the infrastructure in Africa is not as developed as other countries. If you look at even like the rivers, this is coming back to me being like a massive geography nerd. The rivers in Africa are really difficult to transport goods around. So if you think about, compare that to kind of the Mississippi in the USA, it's really easy to transport goods. These are like massive flat plains of these wide rivers. And historically, it was really easy to transport goods. Whereas if you think of like the Victoria Falls, like to transport goods around that is really difficult. So so we don't transport goods as much as we did by river. We do it all by internet. So today there's no constraints on countries in Africa compared to countries in America or Europe. So there's a massive upside in countries in Nigeria at the moment, and that's going through a massive political kind of turmoil at the moment. But like, I looked yesterday to see, I don't think there's any index fund that you can buy on Nigeria or kind of African nations. So that's you might have to pay higher fees, unfortunately, to buy these kind of niche markets. But yeah, this is guidance, not advice. But do your own research. Yeah, sorry, I've gone on a massive tangent.
Oh, good.
Yeah, does that make sense? I can't even remember what your original question was, but
I mean, you kind of touched on something that I was going to ask anyway. At the start, about kind of adding another income to your trading, because obviously trading isn't it's not like a paycheck.
Yeah.
So obviously, when you invest in dividends, you almost know when you're going to get paid. Um, what secondary income would you say could be good for traders to add to the overall portfolio, I guess you could say?
So it depends on what you're looking for. So I mean, you're asking me questions. I've come on a show called TradeHappy. So I, I would say start off investing. Like it's so, and it depends on what your goal is as well. So for the goal that I help people with the most is essentially becoming financially independent. So if you want to financially independent and retire early, so you don't need to work anymore, like start off investing. So put money. If you've got a job and you can put 10% of that money into an ISA every month, and that's going to build up assets that are going to start paying you an income. But yeah, every month just pay yourself for like real basic stuff. I'm sure you can, if you read like The Richest Man in Babylon or kind of Rich
Rich
Dad Poor
Dad, Poor Dad. Yeah.
Dad, kind of tells you that stuff. But yeah, every month, like pay yourself first every month. As soon as you get paid, put money aside into assets. Buy a, an index fund, a broad index fund, that trades the world market, and yes, start putting that aside. And once you have enough capital, so capital is so important. And like it or not, we live in a capitalist economy. We live in the world of capitalism, and the more capital you have, the more better decisions you're going to make. So if you've got,
Mm.
say, £100,000 sat in a bank account, you're you're going to make better decisions, or you're going to have more, be able to pick better trades or better investments for the long term if you've got this capital that you sit on. So it's called capacity for loss. So I don't know if you know that or if you teach that, but it's super important, called your capacity for loss. So what is your capacity for loss? So imagine that one person's got £100,000, that person, and another, it's sat in a bank account, and another person's got £100 sat in a bank account. So that person, and that person with £100,000, they can be like, right, I'm going to spend £50,000 in a broad index fund that trades the world. I'm going to pay £20,000 as deposit for my house. So I've got a house, and then the other £30,000 I'm going to put into bonds, and that's going to be super safe. And in 10, 20 years time, statistically, coming back to the evidence,
Mm.
that guy is going to be pretty, his the stock market might go down 20%, but his bonds are sitting pretty. His property's looking pretty healthy because he's getting paid rent every month, or he doesn't have to pay, so that person's got a higher capacity for loss. The other person who's only got £1,000, if he's sat trading, his capacity to make that £100,000, he's going to have to take a lot of risks. Like even if he buys Bitcoin, which is historically has been quite risky, if Bitcoin goes down 50%, which it can do, as I'm not saying Bitcoin's right or wrong, but it's higher volatility. He's down at 50%, and it's not that he's made silly decisions. He's just got less capacity for loss. So unfortunately, how much capital you have is it makes trading so much easier. It makes investing so much easier. And for someone sat at home, £1,000 in their bank account, that sucks. That's like, oh god, that's really that's not fair, and it's not fair. So the only reason I made £940,000 in a day, like that's not me doing anything relatively clever. That's just me, because I've got working for a FTSE 100 company that's got millions of pounds of assets and capital sat in a bank or with assets. I can take those risks. So I can take higher risks because I've got higher capacity for loss. So it comes down to your capacity for loss. And it sucks as someone at home starting out their kind of trading journey or their investment journey with, you starting with a pound coin in your back pocket. That kind of sucks. By how am I going to be a millionaire by a pound coin in my back? It really sucks, but it's about time. Unfortunately, time is amazing. Like if I made so many silly errors, I maybe should talk about my kind of errors as well. I bought my first. I don't know if you're going to ask me a question about my kind of how I started as well. So I started buying in a .com boom. I started buying and selling on the internet stocks in a kind of .com boom. And yeah, I made lots of mistakes, and maybe I can talk about mistakes it might be helpful
Yeah.
for the person at home as well. But yeah,
Yeah.
I don't know if that answers your question. But yeah, to summarize, capacity for loss is super important, and that comes down to like how you kind of can trade it happier.
Yeah. I mean, I think it's all just like percentages, isn't it? Because if you have, I don't know, 10 mil, or you have 1,000 and you make 1%,
Yeah.
just looking at the actual pound figures, one person's not very happy and one person's very happy.
Yeah.
But at the end of the day, it's the same percentage. Yeah. I mean, I totally agree with what you just said.
But then 1% would be rubbish, would it? If you're getting like inflation's at 2%, what are you talking 1% a day? I guess you're talking about. So that's going to compound over time. But like, yeah, if at the end of the year,
Yeah.
in years because I'm an investor. But yeah, I mean, inflation is to take into account. So people at home sat in it. I guess another thing I see is people making mistakes is sat in cash, thinking they're being really safe, thinking that
Yeah.
put all their money. It's not like a game of poker where you have to put all your money in at one pot. You have to put all in. You can just drip feed it into the market.
Yeah. Yeah. Um, yeah, I totally agree. So, what would you say is lacking in trading education nowadays?
A great question. So historically, we didn't have to understand about the market. So previous generations, you would work you'd work all your life. At the end of that working life, you would get a guaranteed income for life. You'd get a pension, what they call an annuity. So in the old days, you would work at, you go to a standard job, you would work your days, and you'd get you'd get a final salary pension, these kind of gold-plated pensions. And today, those pensions are now basically they're redundant. They're very few, or they're pretty rubbish. They're kind of a watered down version of them. If you're a doctor or a teacher, you might still get them. So these are what they call kind of defined benefit pensions.
Mm.
So previous generations, you could buy an affordable house. So in the 1990s, house prices, they've risen 500% in London since the 90s. So someone's sitting at home like today, you get like my book, Millennial Money Mindset, talks about this. And, millennials are kind of being screwed over by the property market because there's many more boomers, baby boomers, because if you look at the population statistics, there's many more boomers today than there are millennials. So they're much more likely to vote, and they get their say in the kind of the policies. So to win an election, you might want to it's much more sensible if you're a politician to make policies that suit baby boomers, i.e. keep house prices high by doing things like help to buy scheme, keep interest rates low, and print loads of money. It's much sensible if you're a politician to win election to kind of pander to baby boomers. But that means that millennials so when I say millennials, these are 25 to 45-year-olds, have basically been screwed over, I think, personally. And also, you can't buy an affordable house today. And if you had any money left over, say previous generations, you would put money into a bank and you'd get 5% interest rates. And that's sweet. Like, that's pretty good. Today, the base rate is 0.1%. Imagine that. Like, you put money into a bank and you're losing money. Like, that pound coin in your back pocket is eroding every day. It's losing money. So by inflation, so there's a thing called inflation, which is essentially the spending power in your back pocket. So those are three things today. So essentially, the unaffordable housing price, the pension there's no pension market anymore, and inflation, you can't get pound coin in your back pocket. So coming back to your question, what is lacking? So essentially, we need to know about financial education previously. Like you could do your job, and you'd get a guaranteed income for life. Sweet, didn't have to worry about. Today, we now have to understand how to manage our own money. And this kind of sucks. It's like, oh, I've got to work at a job, and now I've got to do this whole other life skill. It's equivalent to, like, imagine you didn't have to drive before. You'd have a horse and cart, and today you have to learn how to drive. And you're like, oh, that kind of sucks. I have to go and learn how to drive. I have to do a test, and that kind of sucks. But the great news is today, you can now, there's never been a better time to learn how to invest. Like, you can go on YouTube, I've got a YouTube channel called Millennial Money Mindset. You can listen to podcasts like this and understand how to invest, which is great. So what's lacking is good education, or I say good education, it's still pretty terrible, but it's improved in the last 5 years. There's much more stuff out there.
Yeah.
But what's lacking is experience. So no one knows how to, you might read a book, which is great. You read Rich Dad Poor Dad, or Richest Man in Babylon, or my book, Millennial Money Mindset, if you want the fruits, you need the roots, and you understand it. Like, that might be great. But it's massive difference between how you understand things by just education. You need experience, actually having money in the market. So if I'm on quite a few kind of Facebook groups, etc. Like that, and when the markets come down, and markets go down all the time, there'll be another financial crash. It's just how markets work. People freak out and people get scared because they haven't experienced this before. And there's things that happen in the brain. There's chemicals get released. There's a thing called the amygdala in the brain, and a chemical gets released, and it makes us kind of fight off. It's called fight or flight reaction. So it's the same. As humans, we've evolved over tens of thousands of years, and this chemical gets released to keep us alive. If we saw a scary bear in the woods, we'd be like, that bear's going to eat us. So this chemical gets released, and it makes us kind of fight or flight, or run away from this scary bear. So when the markets crash and there's this there's a bear in the market, this chemical gets released, and it makes us do silly things. We panic and we get scared, and the markets crash, and we make silly mistakes. And if you don't have someone kind of with you to explain this to you, or you haven't experienced this before, then you're going to do silly things and sell at the wrong time. Or even on the flip side of that, that's when the markets crash, when the markets are really high, when you have exuberance, when we as humans, we get greedy. We can't help it. We get greedy, and we buy into silly stocks when we shouldn't be. We make silly mistakes, and we get greedy, and we buy into bubbles. And so there's a number of different bubbles. I made this classic error when I bought my first stock called lastminute.com. The irony of the lost a minute at a time. I was 18, and this was in the 2000s. Before the internet, imagine a time before the internet, before we could do a Zoom call. I don't even know where you are at today, like where you're calling from, but yeah, we have this amazing thing called the internet, where we can speak to anyone around the world. But imagine a time before this, and I bought a stock called lastminute.com, thinking I was going to make my fortune. I was at sixth form. I was like, I don't really fancy doing this school thing anymore for much longer. I'm going to make my fortune by buying lastminute.com. And yeah, I think and essentially it was pure greed. I was like, actually, yeah, I was working at an ice cream shop at the time. And yeah, I just basically thought, yeah, I was saved quite diligently. And I was like, yeah, I don't want to have to save. So yeah, put half my money into lastminute.com. Had to write a check. Imagine that, you had like these paper checks, and you had to write them out. Then you had to post it, putting it in the post box. It took like a day to get there. A city broker would receive your check. He would then send back an application form. Imagine that. Then he would send an application form. You would fill out that application form, and then you would send that back. And it took like 2 weeks overall. Compared to today, you can and that's, I guess, another thing. Like, today, you can just buy or sell instantly, and kind of that fight or flight reaction. You would just make that trade instantly, rather than having that kind of time to reflect. Just to come back to your question, what's lacking? I would say experience, and yeah, it's having. So I have a coaching program, and I kind of called Money Tips, and we kind of help people, kind of guide people along that kind of help them not make silly errors.
Yeah, amazing. So what would kind of going on from the education. What would you say was the worst piece of advice that you've been given around trading or investing?
Wow, that's a great question. That's a great question. The worst piece of advice? Yeah, I guess. I mean, there's so many bad YouTube channels out there. There's so many bad advice out there. That's the thing. Like, I'm part of this like money bloggers community, and most of
Hmm.
the people are like really really nice. I don't get them. Don't get me wrong. Like, but I guess the downside of kind of YouTube and the internet, and you could just post anything. There's no kind of filter behind that. So I watch some of these YouTube channels, and I'm in horror of like what people say and do, and they think they're being really clever, and they're being genuine. They're being like authentic, and they're being, they're trying to be helpful, but they're just doing the completely wrong thing, and people are going to get really really hurt, and people are going to get really really yeah, they're going to get annihilated basically by doing silly things. So yeah, I'd come back to look at the evidence. I mean, my book, Millennial Money Mindset, on the Fruit You Need the Roots, I've got like, I researched this like hundreds, if not almost like, yeah, hundreds of research. There's like, it's going into kind of Nobel Prize economists. Like I use the modern portfolio theory, this guy called Harry Malkovich. There's like this guy called Sharp, which is like this basically guy who won a Nobel Prize for, he came up with the theory of like risk and reward are related. Like it seems pretty obvious now, but this guy in the 70s, like they gave him a Nobel Prize, believe it or not, for coming up with this theory. And there's another kind of Nobel Prize called like Farmer and French. And basically they came up with this kind of theory that I mean, when I say theory, like they've done like literally like decades of research. I don't want to like they don't want to take away from these guys. Like they literally done like, this was their like life's work. So they've done like studied like thousands of companies. These these two people called Farmer and French, and they did like study like thousands of companies, and they basically said what's working and what's not working, and they brought it down to three things. So momentum, which you can really relate to trading, and I'm happy to talk about that later on. So value companies, like this is stocks, like this is buying companies. So value companies. So what is a value company? So it's looking at the intrinsic value of the company. So is it like the price of that company versus how much earnings they're making? And so momentum, value, and small companies actually was quite interesting. So small companies grow quicker than big companies. So yeah, those three kind of Nobel Prize winning economists was part of my book that I wrote, Millennial Money Mindset. If you want the fruits, you need the roots. And also, I touched on Rich Dad Poor Dad previously, and I think he gets loads of stick, and people like academics almost like sneer at Robert Kiyosaki because he didn't go to university, or he didn't go to university, and he still did research, but he did research on people, his business. I mean, he wrote like 17 books or something. He's sold like 54 million books or something like that. So he has done his own research, but kind of academics kind of sneer at him for not like being academic or whatever. I live in Oxford, so that I kind of maybe I'm I speak to a lot of academic. There's a lot of academics that I speak to, and yeah, he gets a lot of stick for his work that he did. But yeah, I mean, Rich Dad Poor Dad was written in 1997, and he talks a lot about mindset. And I think, yeah, he's one of the most important writers of the about money that in the last 100 years, maybe. And that's so I've got a lot of respect for Robert Kiyosaki, and I don't think he gets the
Mm.
that he deserves. So coming back
No.
to the question, yeah, what mistakes have I seen? Yeah, not looking at the evidence. I guess it's so important. There's so much information and kind of evidence out there. Yeah, and I guess looking at people, have they been successful before? And I guess a lot of people on YouTube have, that I don't. Coming back to the money bloggers, I'm kind of friends with them, and they're all really nice, but like their actual strategies, they don't really understand. They might be good at. So one guy is really good at filming. His kind of background is photography, and which is really good. His videos look really nice and really polished, but he doesn't actually understand investing. And he's talking about investing, and like some of the things he's saying are like, actually, you shouldn't be saying this because that's fundamentally wrong, and you're telling people the wrong thing. Yeah. Sorry, that maybe I had a rant there, but yeah,
All
that
good.
was my kind of opinion.
Yeah. Um, So my
Does that make sense?
final, yeah, it makes sense. Makes sense. If anyone like has any questions or anything, um,
Yeah.
they can just post it into the comments, and um, yeah, hopefully I can
Yeah,
answer
please
them,
do,
or
or
if not,
connect with me.
you
I've
can.
got best way to connect with me is on LinkedIn. So that's how we connected. So Neil Doig,
Yeah,
Neildoig. Connect with me on LinkedIn. My Instagram, just look for it's millennial_money_mindset, or just type in money tips, which tips is spelled TIPPS. It stands for tax, investment, property, pension, savings. I've got a website, moneytips.co.uk. Tips is spelled TIPPS. I've got how else can you? Oh yeah, Facebook, moneytips.co.uk. Yeah, there. I've got or YouTube. I've got a YouTube channel, Millennial Money Mindset. You have to, millennial spelled 2 L's, 2 N's. Or I've got a podcast, Millennial Money Mindset. If you want the fruits, you need the roots.
amazing. Thank you for coming on to the podcast today.